Here is something that happens to real, financially responsible retirees every single year across this country. And I want to walk you through exactly how it plays out, because understanding this scenario is the most important thing you can do for your retirement tax situation right now. You turn 73. The IRS requires you to start taking money out of your traditional IRA, your required minimum distribution. Let's say your RMD is $10,000. Simple enough, right? You take the money, you report it, you pay the income tax on it. That's what you expect. But here's what you don't expect. That $10,000 IRA withdrawal also changes the tax status of your Social Security benefit. It pushes your combined income above a threshold that hasn't been adjusted for inflation since 1983, by the way. And now suddenly, up to 50% of your Social Security check becomes taxable income too. And 2 years from now, because Medicare looks back at your current income to set future premiums, your Medicare Part B premium increases. One withdrawal, 3 separate tax consequences, and most people don't see any of them coming until after they've already happened. Today we are going to go through exactly how this chain reaction works, why it catches so many retirees by surprise, and the specific strategies that can protect you from it. Stay with me to the very end. Welcome to Professor Kingsley. If you're new here, this channel is built for everyday Americans who want to understand the financial and tax rules that affect their retirement income, explained in clear, direct, honest language. No jargon, no talking down to you, just the information you need, delivered the way a trusted friend would deliver it. If that sounds like what you've been looking for, please hit the subscribe button right now and turn on the notification bell. We put out new content every single day, and the topic we're covering today is one of the most financially consequential things any senior with a traditional IRA needs to understand. Let me start by giving you the full picture of what traditional IRA withdrawals actually do to your taxes, because most people understand piece by piece, but not the whole picture together. Every dollar you withdraw from a traditional IRA, whether it's a voluntary withdrawal you chose to take, or a required minimum distribution the IRS mandates you take, is treated as ordinary income in the year it is received. That amount stacks on top of every other income source you receive, including Social Security benefits, pension payments, part-time wages, capital gains, and interest. Together, those sources determine which federal tax bracket applies for the year. The One Big Beautiful Bill Act, signed July 4, 2025, increased the standard deduction to $15,750 for single filers and $31,500 for married couples filing jointly. For seniors who also qualify for the new $6,000 enhanced senior deduction for those 65 and older, the combined deduction package is substantially larger. That's genuinely helpful, but it doesn't eliminate the chain reaction that IRA withdrawals can trigger at the income level before deductions are applied. Here's the critical distinction. The standard deduction and the senior bonus deduction are below-the-line deductions. They reduce your taxable income, the number on which your tax bill is calculated. But the thresholds that determine how much of your Social Security is taxable and whether you owe IRMAA surcharges on your Medicare premiums are based on your adjusted gross income, your AGI, and your modified adjusted gross income, your MAGI. Those are calculated before any deductions, and IRA withdrawals increase your AGI and MAGI dollar for dollar. That's the chain reaction. Let's go through each link of it. Link number 1 is the most fundamental, the bracket push. The federal income tax brackets for 2025 and 2026 under the One Big Beautiful Bill are 10, 12, 22, 24, 32, 35, and 37%. These brackets are marginal, meaning only the income above each threshold gets taxed at the higher rate, not all of your income. But a large enough IRA withdrawal can push a meaningful portion of your income into a higher bracket, and that has a compounding effect that retirees consistently underestimate. Consider a married couple, both age 75, with $1.6 million in combined traditional IRA balances. Their RMD might total approximately $64,000 that year. With $45,000 in Social Security benefits added, their gross income reaches $109,000 before deductions. After the $31,500 standard deduction and $12,000 in combined senior bonus deductions, their taxable income exceeds $65,000, placing them firmly in the 22% bracket. Any investment income on top of that risks crossing into the 24% bracket. The bracket effect compounds year after year. As IRA balances continue earning returns, subsequent RMDs grow larger, not smaller, potentially locking retirees into elevated brackets indefinitely without a counter strategy. That last sentence is the one I want you to really sit with. RMDs grow. Every year that your IRA account grows, and most investment portfolios do grow over time, even during the distribution phase, your future RMD grows with it, which means the bracket pressure doesn't decrease as you get older. Without deliberate management, it escalates. RMDs could cause more financial harm than just larger tax bills in retirement. It's important to be aware of these consequences and take a proactive approach to minimizing the impact of RMDs, whether via strategic withdrawals or Roth conversions, before it's too late. Link number 2 in the chain reaction is the one that surprises people the most, the Social Security taxation trigger. And this is where a single IRA withdrawal can produce a tax cost that is significantly larger than the straightforward income tax on the distribution itself. IRA withdrawals and Social Security benefits interact for tax purposes, and poor coordination can make up to 85% of your Social Security taxable. Taking traditional IRA distributions increases your AGI, which can push more of your Social Security benefits into the taxable range. The IRS uses combined income to determine how much of your Social Security benefits are taxable. Traditional IRA distributions increase your AGI, which can push you into higher combined income brackets. Here's how combined income, also called provisional income, is calculated. You take your adjusted gross income from all sources, you add any tax-exempt interest income, and you add half of your Social Security benefit. That total is your combined income. Now compare it to the IRS thresholds. For single filers, if the combined income is between $25,000 and $34,000, then up to 50% of benefits may be taxed, and above $34,000, up to 85% of benefits may be taxed. For married couples filing jointly, if the combined income is between $32,000 and $44,000, then up to 50% of benefits may be taxed. The key thing to understand is that you might have heard that the 2025 tax bill eliminates taxes on Social Security benefits. It does not. The new law doesn't change the Social Security benefit tax formula or the IRS combined income thresholds. Now here is the specific scenario from the current research that illustrates exactly how this plays out. Say you're single and your only retirement income is a $3,000 monthly Social Security check. Half of that, on an annual basis, is $18,000, which puts you below the threshold for having to pay taxes on your benefits. But now let's say you're on the hook for a $10,000 RMD this year because you've turned 73. That gets added to the $18,000 above, pushing your provisional income to $28,000 and leaving you subject to taxes on up to 50% of your Social Security benefits. If they withdraw $10,000 more from their IRA, their provisional income rises to $30,000, and up to 85% of benefits could become taxable. What this means in real terms is that the effective tax cost of that IRA withdrawal isn't just your marginal bracket rate applied to the withdrawal amount. It's your marginal bracket rate applied to the withdrawal amount, plus your marginal bracket rate applied to the additional Social Security income that the withdrawal has now pulled into taxable territory. Tax professionals call this the tax torpedo, the zone where each additional dollar of IRA withdrawal costs you significantly more in total taxes than your stated bracket would suggest, because of the simultaneous Social Security taxation multiplier effect. And critically, RMDs can create a tax surprise because retirees may not need the money, but the IRS still requires the distribution. This is the cruelest aspect of the problem. You didn't ask for the extra income, you don't need it to live on, and yet you are being taxed on it as though you did, including the taxes it pulls in on your Social Security. Link number 3 is the one that arrives 2 years after the income event that caused it, which is why so many retirees never connect the two. It's the IRMAA Medicare Premium Surcharge. Traditional IRA withdrawals, including required minimum distributions, count as taxable income, which raises your modified adjusted gross income. That's important to understand because Medicare uses your MAGI from 2 years earlier to determine whether you owe an income-related monthly adjustment amount, or IRMAA, surcharge on top of your standard Part B and Part D premiums. For example, IRMAA kicks in for singles with MAGI above $109,000 or $218,000 for married couples filing jointly in 2026. Making a large IRA withdrawal in a given year can easily push you over these thresholds, triggering higher monthly premiums that apply for the entire following year. Even a $1 bracket change can add hundreds or thousands of dollars annually in surcharges, with couples possibly facing double the impact. The standard Medicare Part B premium for 2025 is $185.00 per month per person. The IRMAA surcharges reflect published thresholds. Your 2025 income will determine 2027 premiums, with thresholds expected to adjust upwards slightly each year for inflation. This 2-year lag is what makes IRMAA the most disorienting of the 3 chain reaction consequences. You took a large IRA withdrawal in 2025 because you needed the money or because you didn't realize the consequences. The 2025 and 2026 tax bills were painful but understandable. And then in 2027, your Medicare premium goes up, and many retirees don't immediately connect it to the income event from 2 years prior. They just see a higher bill with no clear explanation. Taking action to manage modified adjusted gross income this year creates a direct financial benefit 2 years from now. That's the planning opportunity, and it's the one most retirees miss entirely because they're only thinking about the current tax year. Now let's talk about why voluntary IRA withdrawals, not just mandatory RMDs, are so frequently taken at the wrong time, in the wrong amount, with no regard for these chain reactions. The most common mistake I see is the large, unplanned withdrawal. You need money for a home repair, you want to take a vacation, a family member has an unexpected expense, and your IRA looks like a simple source of cash, available, accessible, seemingly straightforward. What doesn't get considered in the moment is whether that withdrawal will push your combined income above a Social Security taxation threshold, whether it will cross an IRMAA tier and elevate your Medicare premiums 2 years from now, whether it's being taken in a year when your income is already elevated from other sources, creating a compounding bracket effect. For example, let's say you're 75, single, and ended 2024 with $2 million in your IRA. According to the table, your distribution period is 24.6, which means your RMD for 2025 would be $81,301. If you also take an additional $30,000 voluntary withdrawal from the same IRA in the same year, on top of that $81,301 RMD, the combined effect on your combined income, your Social Security taxation, and your future IRMAA exposure is far larger than most people realize when they make that withdrawal decision. The second mistake is failing to begin voluntary withdrawals early enough. One strategy is to begin taking withdrawals from retirement accounts that are subject to RMDs once you're old enough to avoid early withdrawal penalties, meaning age 59 and a half or later. If you have a $1 million IRA, but you start tapping that account at age 60, by the time you turn 73, you may not have very large RMDs to worry about. That said, you don't want to blow through your IRA simply to avoid RMDs. The strategy works if, for example, you have other income saved you can use once you turn 73. It can also work if you withdraw from your IRA to reduce RMDs, but reinvest the money or save it elsewhere. This early withdrawal strategy is not widely discussed, but it's logically sound. By voluntarily drawing down your traditional IRA in the years between retirement and age 73, years when your income may be lower and your bracket more favorable, you reduce the balance that will be subject to mandatory RMDs. Smaller RMDs in later years mean a smaller annual forced income addition, which means less Social Security taxation exposure and lower IRMAA risk compounded across years. Now let me give you the 3 most powerful tools for managing this entire problem, tools that are legal, IRS confirmed, and available right now to qualifying retirees. The first and most impactful tool is the Roth conversion. Roth conversion strategies for retirees during low-income years, such as the gap between retiring and taking Social Security, could help reduce future RMDs. They may help to avoid pushing your Social Security benefits into higher taxable brackets. However, Roth conversions are taxable in the year they occur, so careful planning is essential. If you start doing conversions at age 60, you can spread them out over more than a decade, thereby leading to a moderate but not overwhelming tax bill each year. The strategic logic is straightforward. The years between when you retire and when you begin taking Social Security, and then between Social Security and age 73, when RMDs begin, are typically the lowest income years of your entire retirement. These are the years when your marginal rate is most favorable. Converting a portion of your traditional IRA to a Roth IRA during these years, at a 12 or 22% federal rate, permanently removes those dollars from future RMD obligations, future Social Security taxation calculations, and future IRMAA exposure. The tax you pay today on the conversion is almost certainly less than the combined tax cost, ordinary income tax plus Social Security taxation plus IRMAA premium increases, that those same dollars would create as mandatory RMD income in later years. Generally, qualified Roth IRA withdrawals do not count toward your MAGI, which is one reason many retirees use Roth conversions in lower income years to manage future IRMAAs. The second tool is the qualified charitable distribution. If you are at least 70 and a half years old, you are eligible to make charitable donations via qualified charitable distributions. In particular, you can distribute up to $111,000 or $222,000 if married and filing jointly from your IRA to any qualified charity without having this sum added to your adjusted gross income. These distributions count toward your RMD but are excluded from your taxable income, helping reduce the impact on your Social Security taxation. This strategy is especially useful if you're charitably inclined and want to minimize tax exposure. The QCD is the most direct and immediate tool for managing the RMD chain reaction. It satisfies your RMD obligation, so no penalty, without adding the distributed amount to your AGI, which means it doesn't push your combined income higher, which means it doesn't trigger additional Social Security taxation, which means it doesn't create future IRMAA exposure. The charity receives the full amount. You owe no income tax on it, and your retirement tax picture is cleaner for having done it. The third tool is bracket-aware withdrawal planning, which simply means knowing where you stand in your current tax bracket before making any IRA withdrawal and understanding how much additional income you can take without crossing into the next bracket or the next IRMAA tier. At Mercer Advisors, the strategy involves helping clients fill up lower tax brackets without crossing into higher ones. This means calculating your total income for the year from all sources, comparing it to the bracket thresholds and the IRMAA thresholds, and then sizing any voluntary IRA distributions to stay within the favorable range. It's not complicated. It requires knowing your numbers, and the payoff is avoiding unexpected tax costs that would have arrived without any benefit to you. Let me also address the new tax landscape for 2025 and 2026 specifically, because there are elements of it that affect this calculation in ways that matter for planning. The bracket effect compounds year after year. Proactive planning, well before mandatory distributions begin, is the most reliable way to reduce the compounding impact of RMDs on taxes and Medicare premiums. Converting pre-tax retirement funds to a Roth IRA between retirement and age 73 is the single most powerful long-term strategy for reducing future RMD amounts. Paying income tax on converted amounts during lower income years reduces the balance subject to future mandatory distributions. Smaller future RMDs mean lower taxable income, less Social Security subject to tax, and potentially lower IRMAA exposure 2 years later. Retirees who convert in systematic annual increments can dramatically reshape their retirement income profile over a decade without triggering bracket spikes in any single year. The new $6,000 Enhanced Senior Deduction, available for tax years 2025 through 2028 for qualifying seniors 65 and older, does reduce taxable income and reduces the tax bill on whatever income ends up being taxable. But as I mentioned earlier, it operates below the AGI line. It does not reduce your combined income calculation for Social Security taxation purposes, and it does not reduce your MAGI for IRMAA purposes. It's a valuable benefit, but it is not a substitute for the above AGI line strategies that actually control the chain reaction. Even routine distributions and benefits can carry tax consequences. For retirees, monitoring RMDs, Social Security, investment income, pensions, and new state tax rules now can help you avoid surprises at tax time. Let me now give you the practical action plan that brings everything together, because information is only valuable when it leads to actual decisions. Action 1. Calculate your projected combined income for this year, your AGI from all sources, plus any tax-exempt interest, plus half your Social Security benefit. Know whether you're in the 0, 50%, or 85% Social Security taxation tier. Know your IRMAA exposure based on this year's income affecting your 2028 Medicare premiums. Action 2. Before taking any voluntary IRA distribution this year, for any reason, calculate the marginal tax impact of that distribution, including the Social Security taxation it might trigger and the IRMAA exposure it creates 2 years from now. The combined cost is almost always higher than the face value income tax on the distribution alone. Action 3. If you are 70 and a half or older and you give to charity, execute your giving through a QCD from your IRA. Direct your custodian to send the check payable to the charity, not to you. This satisfies your RMD obligation, excludes the amount from your AGI, and prevents the chain reaction entirely for those dollars. Action 4. If you are between retirement and age 73, evaluate whether Roth conversions sized within your current tax bracket and below IRMAA thresholds make sense for your situation. Systematic annual conversions over a decade can dramatically reshape your future RMD profile and its associated tax chain reaction. Action 5. Have a multi-year retirement tax planning conversation with a qualified professional, not just a tax filing conversation. The IRA withdrawal chain reaction plays out across years. Managing it requires a multi-year view of your income trajectory, your bracket exposure, and your IRMAA picture, a view that single-year tax filing simply doesn't produce. Here's what I want you to carry away from everything we've covered today. Retirement income taxes are not just about the rate on what you earn. They're about the chain reactions that certain income events create, how an IRA withdrawal changes the taxability of your Social Security, how your current income determines your Medicare premiums 2 years from now, and how the bracket and threshold effects compound across years without a deliberate counterplan. The way you manage your IRA can either protect or erode the after-tax value of your Social Security benefits. The key is planning rather than reacting later. The small steps you take today can make a meaningful difference in how much you have on hand in retirement. You now understand the chain reaction. You know the 3 tools that manage it, and you have 5 specific actions you can take. That puts you ahead of the majority of retirees in America who are discovering this after the tax bill has already arrived. Before you close this video, please share it. Think of one person in your life with a traditional IRA who has never thought about how their withdrawals interact with their Social Security taxation or their Medicare premiums. Hit the share button right now and send this to them. 3 seconds to share. Real money at stake for someone you care about. And drop a comment below. Tell me, did this video change how you're thinking about your IRA withdrawals? Are you currently in the gap years before RMDs and reconsidering your Roth conversion strategy? Have you already experienced an unexpected tax bill from this chain reaction without knowing what caused it? Tell me. I read every comment, and this community's questions shape every video I make on this channel. This is Professor Kingsley. Plan the chain reaction before it chains you, and I'll see you in the next one.